Hello and welcome to this session in which we'll discuss what is Nexus. Now, why do we need to learn about this concept that's called Nexus? This concept deals with taxation within a state or taxation between states. In the United States, we have many different states or many different jurisdiction, taxes jurisdiction. For example, I am located in Pennsylvania. I sell goods and services in Ohio, New York, maybe Texas, California. What is my relationship? Do I have to pay taxes in these states? In other words, am I responsible for filing an income tax, state income tax in Texas? Now, obviously, I'm expected to file a federal income tax for the whole country. How about state? Because each state is independent. Well, what do we have to learn about? We have to figure out whether Farhat lectures have any nexus in any particular state. If I have a nexus, then yes, I have to pay taxes in that state and file the income tax return of that state. So this is what we need to learn in this session. What is nexus and how is nexus established? Then I have to, if it is established, then I have to file income tax in that state and pay taxes. Let's go ahead and discuss what is nexus first. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Nexus refers to a business connection or presence within a particular state or jurisdiction that is sufficient to establish some sort of obligation. Somehow I'm connected enough to that state that I have to comply with that state tax laws. And usually, what does that mean? It means I have to pay taxes. Am I somehow connected to your state? If I am, then I have to pay taxes. I have to file in your state and pay taxes. This concept is crucial for determining whether a business is required to collect and remit sales tax, pay income tax, specifically income tax, because you're going to see sales tax is pretty straightforward, but paying income taxes, this may or may not be established or comply with other state tax obligation. So the criteria to establish nexus can vary from state to state because each state is independent from the other state. Each state, they can have their own rules, and you have to comply with those rules if you want to operate and sell in that state. But not all states have the same rules. So maybe one rule would establish a nexus in a certain state may not establish a nexus in another state. In this session, we're going to talk in general because we are teaching you this either for the CPA exam or for your accounting courses. You're taking an income tax course. So we don't learn about any particular state law, but we're going to be looking at general state laws. So for you to understand what is a nexus. So I'm not going to discuss initially what could establish nexus. I'm going to keep this toward the end. So at the end, I'm going to tell you, here's what could establish nexus, and therefore you are responsible for paying income tax in these states. First, I'm going to start with some exceptions. What can protect you from paying taxes? Then we would look at what will at the end. Starting with a public law number 86-272. All what you need to know is there's a federal law that provides some protection for businesses that engage in interstate commerce. What is interstate commerce? Interstate commerce, when you sell in other states, when you are located in one state, but you sell in other states. Well, if you sell in other states, do you have to file income tax in those states? Well, not necessary, because there's a federal law that says, well, if you meet certain conditions, you don't have to file income taxes in those states. So let's take a look at this public law. First, if your business activity is limited to solicitation orders. So let's assume you sell in those states, but the only thing that you do within that particular state, let's assume I am in Pennsylvania and I am soliciting business in New York. Well, if I am soliciting business for tangible items means items that I can that you can touch, you can see, like furniture, electronics, books, things that you can touch. I'm okay as long as I am soliciting. Soliciting means I am trying to sell you. I'm advertising. I have salespeople, or I'm advertising in your state. I am protected. Let's assume after I solicit the order is processed outside the state. So I have salespeople in New York. They are soliciting sales to my company, but once they obtain the order, they can send the order to Pennsylvania, and we decide whether we want to accept the order or not. But the sales is not made inside the state. So we solicit it, the decision is made outside the state. This means the decision to go ahead with the sale is not made inside the state. Also, when I ship the product, let's assume I'm selling furniture. When I ship the product, if the business decide to accept the order, they send the product from a location outside the state. Guess what? Then I don't have a nexus in New York because I'm selling a tangible good. Yes, I have people working there. They solicited the order, I accepted the order in Pennsylvania, and I shipped the furniture from Pennsylvania. Simply put, if a company only activity in a state is to ask for orders for physical, tangible product, and these orders are processed and filled from outside the state, then that state cannot tax me on my income from these sales. So this law is designed to do what? To protect businesses that operate across state lines, especially those don't have significant physical presence in the state, but they still want to sell product to that state. Example, let's look at an example. A company called Go Gadget Pro is headquartered in Ohio. They manufacture and sell gadgets like smartphone and tablets, physical goods. They don't have any stores or offices outside Ohio, but they sell their product across many states. Well, in California, they have a few sales representatives in California, and their only job of these sales representatives is to meet with potential customers, like electronic retailers, and try to sell them the Gadget Pro product. So these sales representatives don't take orders directly, they just encourage you, they show you the product, they'll say, if you want to buy, contact our office or go online and contact our office in Ohio. Okay? When a retailer in California decides to order from the Go Gadget Pro, they will send an order to the headquarters in Ohio. The company reviews the order, and if they want to accept, they will accept, and if they accept, they ship the product. They ship the product from their warehouse in Ohio. What does that mean? Do we have any connection to California? Well, under this public law, we don't. So, in this scenario, Gadget Pro activity in California is limited to solicitation, which are and for solicitation tangible product. Ohio accept the order, and we ship the product from Ohio. Guess what? We are protected under public law 86272, and we don't have to pay income tax in what? In California, because those three conditions are met. So this law effectively protects Gadget Pro from certain state taxes despite having a business presence there through sales representative. Now remember, I'm gonna emphasize this point here. Income tax. Now we might have to pay other taxes, which we will see later. Let's discuss what this public law does not apply to. So this public law, which prevents states from taxing the income of certain businesses, has some exceptions. What does it not apply to? Well, if individual living in the state, well, simply put, the law does not protect individuals who live in the state, who are residents, or they have primary home in that state. So simply put, if you live in that state, your domicile in that state, well, it doesn't protect you. You have to pay taxes in that state. This means if you are a resident of a state, and here the individual could be an individual, or could be a corporation, it could be a partnership. So if you're a resident of a state, or your primary home in that state, you can still be taxed on your net income by that state, even though your income come from an interstate commerce. So what does that mean? If you live in Ohio, and all your sales are outside Ohio, but you live in Ohio, that's your home, that's your domicile. You are subject to the state income tax in Ohio. So individuals, and I mentioned corporation, if you are incorporated in that state, well, if a company is legally formed under the law of that state, well, then you are responsible for paying taxes in that state. So a corporation that's incorporated in that state can still be subject to the income tax, regardless of whether its income comes from selling goods across state lines. For example, you could be incorporated in Ohio, but all your sales are in California. Well, you are still subject to the Ohio state because you are state income tax because you are incorporated in Ohio. Also, companies selling services. Services are non-tangible product. This law, the law protection, only applies to businesses who are soliciting tangible personal property, which mean items you can physically touch and handle. We have tangible and not tangible. If a company is selling services like consulting, legal advice, digital services, simply put, digital services are download software, digital books, this law does not protect them, so does not apply. These companies can be subject to the state income taxes even if they are only soliciting orders in that state and conducting other business activities elsewhere. So again, it only protects you from tangible physical goods. So simply put, this law protects businesses that are out of state and only soliciting orders for physical goods, not services or intangible products. Simply put, public law number 86272 does not apply to services or digital good. Just, whether it's an individual selling them or corporation. Also, this federal law has limited application. It only prevents taxes from taxing you for net income, under certain condition. We discussed those conditions. This law does not apply to other taxes. So we have many different taxes. The taxes that we were referring to earlier are net income. In other words, you're paying taxes on your profit. This law does not apply to sales and use tax. When you sell product in a state, the state can impose sales or use tax, which is the same thing. This law does not apply a state from charging sales tax on items sold within its border, even if the seller meets the law criteria. It doesn't apply there. It has limited application, and the limited application is to your profit. Also, the state can impose what's called franchise tax. So the state can say, look, you're selling in my state, I'm going to be charging you a fee. That's not income, that's a fee. These taxes are for the privilege of doing business in that state. If you want to conduct business in that state, you have to pay a fee of $500. It's called a tax, it's called the franchise tax. This law does not apply to that tax. Also, in certain state, remember when I say certain, for example, franchise taxes, it can be in certain states. Not all states have franchise taxes. Not all states have sales taxes. Most states have sales taxes. Same thing with the gross receipt states. Certain states, listen to me carefully, certain states are based on total revenue of a company, not net income. So if you meet a certain threshold of revenue, then you have to pay taxes regardless of the federal law. So the state can have those different rules. And once they have those different rules, that state law, that federal law don't protect you. So you have to be careful in the states in which you are operating. That's the point I'm trying to make. Also, remember we talked about solicitation. We said as long as you are soliciting, you're in good shape. Remember, soliciting for tangible goods. And you are placing the order outside. You are accepting the order outside the state and shipping the order from outside the state. But let's go back to solicitation. Well, guess what? You have to be very careful what you are doing if you are soliciting. So state defines solicitation, which is the act of asking, in a very specific and narrowed way. This means any activities beyond order taking. For example, if you are soliciting order, but you are also providing customer support or making deliveries, well, guess what? You might lose the solicitation aspect of it. So in other words, you have to be very careful. If you're only soliciting orders, you cannot act also as a customer service and help the business, answer questions, service the client, because this might disqualify you under the protection of that law. And always state resolve ambiguity in their favors. If there's any uncertainty, I'm only soliciting, but not really, you're not soliciting, it's going to be in the favor of the state. If there's any uncertainty or ambiguity of how this federal law applies, the states often interpret it in a very narrow way to their favors. And simply put, the federal law that we are discussing here is quite limited. It only stops states from taxing the net income under very specific condition relating to selling tangible goods. It does not protect you from, what I'm trying to say, from sales tax, franchise, or gross receipts. And also be careful about solicitation. It has to be merely 100% solicitation. Let's take a look at an example. Office supplies, based in Illinois. Office supplies manufacture and sells office supplies like papers, pens, and folders, physical goods, to people across the US. They sell in Florida, and they have sales representative in Florida. Their job is to meet with business clients and encourage them to place order. They don't take the order directly. They would say, if you want to place the order, go to our website or contact headquarters. So all orders are sent to the headquarters in Illinois, where they are processed and approved. The headquarters in Illinois, not in Florida. Okay. Shipping are from the warehouse in Illinois to customers in Florida. Are we protected? So far, we are protected. So far, so good. So office supplies in this situation is protected from paying net income tax in Florida because their activities are limited to soliciting orders for tangible goods approved in Illinois and shipped from Illinois. However, the state of Florida can still impose sales tax. Office supplies still needs to collect and remit sales tax on product it sells in Florida. Florida can also impose a franchise tax for the privilege of doing business in Florida. I'm not sure if they do have it or not. The point is they can. So Office Plus might need to pay this tax regardless of the federal law. Also, Florida might have gross receipt taxes. If Florida has a tax on total revenue from sales within its border, they would have to pay this tax as well because they have specific gross receipts tax. And this I don't want to go into the law, but this gross receipt tax came as a result of online sales. Because if you're selling too much in that state, they want to get you under the gross receipt taxes, but we're not going into those specific laws. Remember, the state can have a narrow interpretation of the solicitation. Suppose Florida have a narrow definition of solicitation. So if office supplies representative do anything more than just trying to get the order, like if they provide any customer service, setting up the product display, or anything like this, it might disqualify Office Plus from this protection, and they could be liable for state income taxes. Simply put, Office Plus is protected from Florida net income taxes due to its limited activities in the state, but it could still face other taxes like sales tax, franchise tax, gross receipts tax. And in Florida, interpret solicitation narrowly, any additional activities by the sales rep, kaboom, it could bring you under the Florida income tax system. So what establishes nexus or connection to that state? Well, again, nexus is a fancy word for having enough connection that you have to follow their state tax laws. Here are some activities that can create, it means may create, doesn't have to be in every single state, but they could create nexus. One, if you own or rent property in that state. If a company owns or rents space like office space, warehouse, or even equipment, it's considered to have nexus. Because if you have those physical existent tangible asset, you own property in that state. Therefore, you have a nexus. Sending employees to work or training. Well, if a company sends employees into a state for any business-related activities like work assignments or training, this could also establish a nexus. Could, again, it's like employees having physical presence in that state through that employee. Soliciting sales, you might be saying, but soliciting, we said it's not. Well, depending, but sometimes soliciting sales can. This means actively seeking out customers in a state to sell product or services. If a company is trying to make sales in a state, either through salespeople, advertising, or other means, it's usually seen as having a nexus there. Could, again, not in all states could. Remember, whether you are selling goods, tangible versus intangible. So keep that in mind. But generally, if you have people working in that state, selling services, that could establish a nexus. Also, providing services to customers. If a company offers services like installation, maintenance, repair in a state, whether they're doing it themselves or through a third party, this could create a nexus. If a company using a third party, it's like operating within the state through an arm, through another arm. Handling orders and returns within the state. If a company accepts, process, or reject sales order within a state, or if it handles return, this could establish a nexus. Again, all these 5 factors could, might establish a nexus. Because, think about it, handling orders and returns, these actions are part of a business sales process and it's happening within the state, then you have a nexus. In simple terms, if a company is doing things like using property, sending workers, selling product, providing services, or handling orders and returns, and that means it's involved enough to that state and it could be subject to its state law. Okay, let's take a look at an example to illustrate this. We have Elite Tech, headquartered in Texas. They manufacture and sell high-tech equipment like smartphones, smart home devices, and wearables. Well, they have a warehouse in California. Well, Elite leases a warehouse in California to store product and fulfill local orders. Although they are based in Texas, they could have a warehouse in California. They provide a training in New York. The company sends a team to New York for training seminars. They have salespeople in Florida. They want to sell in Florida, and those people are actively seeking orders in Florida, and servicing customers. They have a third-party maintenance in Ohio. They contract with a local Ohio company to provide installation and maintenance service for their product in Ohio. And they have an order processing in Illinois. Have a small office in Illinois where some orders are accepted and processed. They also handle returns at this location. Okay, let's see how these activities trigger nexus. Well, guess what? California, we have a warehouse. That creates a nexus for us. Well, in New York, we send employees for training. It created a nexus. In Florida, we have a sales team seeking sales and servicing customers. Ohio, we're providing installation and maintenance, even though through a third party, this creates a nexus. In Illinois, we're handling returns. And what does that mean? Again, if we're handling return and process orders, we are conducting business in that state. That create a nexus. So notice in this example, we would likely be subject to state laws in California, New York, Florida, Ohio, Illinois, and all these states. This shows how different types of engagement in multiple states could lead to various tax obligation in each one of them. Now the question becomes, how much do you have to pay taxes? How much is your responsibility? Well, this is what we're going to try to establish next lecture. So in this lecture, all what we're trying to do is look at the concept of nexus, what create nexus, but we have to determine the amount. How do we determine how much are you responsible for paying in taxes? Let's take a look at this multiple choice questions from Farhat Lectures to help us understand this nexus concept. What activity is most likely, notice the word most likely, to create a sales nexus for an online retail business in a state? So, most likely, having a high number of website visitors from that state. Would that create a nexus if people from that state are going to our website? I would say not necessary. Storing inventory in a warehouse located in that state. Hold on a second. Here, yes, I am an online retailer, but notice here I have a physical presence because I have a warehouse. I would hold on that. Running an online advertisement targeted at customers in that state. I'm running online advertisement. Well, that could, but I would say the physical presence is going to create a sales nexus for me. So I would say between C and B is better. A is definitely out. Just because people visit you from that state, it doesn't mean I'm responsible for paying taxes there. Selling digital product like ebooks or software to customer in that state. This could also create a nexus, but not necessary. So the strongest activity that create a sales nexus for me is having a physical presence. Remember, selling digital product, depending on the state. Some states they do based on a sales revenue, others don't. So that's why D is not. The strongest one is B. Having a physical presence will create a nexus. Even though you're an online store, you have a physical presence in my state, you created a nexus, I'm going to tax you. What should you do now? You're going to go to Farhat Lectures, look at additional MCQs. That's going to help you understand this nexus topic. In the next session, we would look at actual number to determine how much you are responsible for paying in various particular state. Invest in yourself. Whether you are studying for your CPA exam, EA exam, or you're an accounting student, good luck, study hard, and of course, stay safe.